real estate. Even though I was working, even though I was still going to college, I started buying 1 or 2 houses a month, and I built up a portfolio of rentals. What I loved about this business is the structure and working with the seller of the property and creating the win-win situation. And in that, I learned that the financing side of real estate is really, that's the deal structure. That's where everything happens. That's how you write your offers, how you negotiate your offers. So I started lending money. At first, it was as a mortgage broker, and then I was just banging my head against a wall because I didn't have control, and I was approving people for homes, and then the guidelines would change and they were no longer approved, and it was just tough. So I went and worked with a lady. Her name was Susan. Now, Susan, this is in 2006. Susan taught me how to raise private capital and lend that money out to real estate investors. So now I had some control over my business. We worked together for 2 years, and then 2008 hit, and a lot of us understand what happened then. Complete crash in the housing market, and she decided to exit real estate actual transactions and just focus on teaching it, because teaching it is a lot safer than actually doing deals. I'm a deal guy.
Kevin,
yeah.
Really quickly, I think your microphone is rubbing against your collar and it's making a lot of static.
Okay.
Or somebody else is doing that. For whatever reason, Microsoft Teams is giving me a failed action when I try to mute people. So I can't mute people. So if you're out there, please mute yourselves. And I'll just let you know that I think that was your microphone. I'm not 100% sure, but
all right, I'm going to try to hold it away from my shirt. But is that any better?
So far.
All right. So Susan and I separated so I could, I wanted to continue doing deals even through the crash. So in 2008, I started Pine Financial. Now we have almost $100 million in assets that we're managing at any given time. All right, so the next slide tells you what we're going to talk about today, which is private money lending. We're going to talk about 3 things: what it is, how is the investment made, how do you profit from it, and then maybe most important, how do you stay safe? And that's really what we want. And this is really why investors love private money lending, is because you can make money just like with real estate investing, but if it's done right, it's safer than owning the property itself, which we'll talk a little bit more about. So next slide. Actually, let's just cruise through that one, and you can just hit it a few more times. Okay, so what is private money lending? So this is my little fun graphics to try to help explain it. It's really simple. Private money lending is just mostly just 2 people coming together and negotiating a deal. Like, I'm going to loan you money, you're going to borrow money from me. Now, it's typically, especially what we're talking about today, it's typically secured by real estate. And then there's terms with that. So I'm going to borrow it for X amount of time. I'm going to get X amount of return on my money. You're going to be able to use it for this and this and this. You know, all of the terms that go into any kind of note whenever you're lending or borrowing money. So it's really that simple. It's just a transaction between 2 people or 2 entities or an entity and a person, and secured by real estate. So the next slide. Savvy investors love private money lending. I alluded to it before, but it's if it's done right, it's safer than owning the property itself. It also produces steady, passive cash flow. And you'll see, we'll talk about it, pretty high returns. It's not going to be as high overall as if you owned the property yourself, because when you own the property, you're going to get the cash flow, you're going to get the tax breaks, you're going to get your tenant paying off your mortgage, and you're going to get the appreciation. You add all of that up, you would probably find that owning the property pays a little bit better. It's just more work and a little bit more risk. So that's why I see a lot of successful investors lend money. So how is the investment made? You're going to find a deal, qualify the deal, make the investment, and service the investment. Those are the 4 steps. So the first one is find the deal, which we find on the next slide. All right, as a real estate investor, we're so focused on finding the deal, right? We're sending out the direct mail, we're making those phone calls, we're working with the real estate agents and the realtors, wholesalers, whatever it may be. In this space, the private money lending space, we're not looking for the deal, which makes it so much easier. What we're looking for is the borrowers that are looking for the deals. You find the borrower brings the deal to you. So how do you find the borrower? Networking is the number one place to do it. Groups like this, like Daniel's put together, like where I'm at now in Minnesota, different conferences and networking events. Obviously, realtors, they want to get deals closed. They get paid when they get deals closed. So they're going to refer business to private money lenders. Friends and family, title companies, it's not uncommon for deals to fall apart the day of or the day before a closing. And title companies would, if you build those relationships, will call you and say, hey, can you help fund this deal? And then finally, wholesalers. I'm assuming everybody knows what a wholesaler is, but quickly, wholesalers is just a real estate investor that's out there looking for deals, but they don't want to actually rehab a deal or own the rental property. They just want to get out of the deal quickly. So they'll mark it up just a little bit and then wholesale it or flip it to another real estate investor to buy and rehab. Seminars, absolutely. This is a fantastic way to find borrowers if you want to get serious about private money lending. If you could put on little webinars or little seminars, that will attract clients to you. Direct marketing, not my experience, not quite as successful as these other methods, but there's internet, there's direct mail, there's cold calling, and then of course, social media. Now I put social media as a direct marketing because you could market through social media, obviously, but that could very easily be slid up to the networking tab there, the networking bullet point there. If you're talking about what you do and how you help other people, that is networking. So social media is fantastic. And then finally, mortgage brokers or private loan brokers. So real quick, when I started this, the way Susan taught me how to do this business was to get one private money lender and one real estate investor that has a deal and basically put them together and then charge a fee for it. So back in the day, it's changed some, but back in the day, we would charge 4 points in origination and 15% interest. So my investor would get 15% in that example, and then I would take the 4 points as the fee to bring them together. So that brokers like that are a fantastic way to find these types of deals. One thing I will say real quick is that those types of brokers have to have a very specific securities license. At least that's how it is in most states. So I would be sure that you understand that they're appropriately licensed if you're going to start working with brokers. Oh, I just keep trying to change this slides and it's throwing me off, Daniel. All right, fantastic. So qualifying the deal after you get the borrower leads coming in, or once you get someone that calls you and says, "Yeah, can you loan me money on my real estate deal?" You really want to make sure it's a solid deal for your portfolio. So what we look at are these financials is first. I want to know the financial statement. What are your assets? What are your liabilities? What's your income and what's your expenses? With all of those, we can kind of basically help us underwrite the deal to make sure that it's an appropriate loan for that borrower. And we can go through questions about that and what is appropriate and maybe not appropriate if you would like. We do pull a credit report. I'm not necessarily qualifying on the credit report. I'm more concerned about the deal itself, and the deal is going to be profitable and the deal will be able to pay me back, not necessarily the borrower. Although I want to know if they're not making any of their payments, or if they're behind on their own mortgage, or if they have a lot of credit card debt that might turn into a bankruptcy. So those are the types of things I'm looking for in the credit report. The supporting documents, that's going to be basically everything you told me in your financial statement. Let's just make sure that that's true. So what's the tax return? What's your bank statement look like? That kind of thing. Repairs. Private money lenders, for the most part, or hard money lenders for the most part, they want to know what the property is going to be worth once it's fixed up, and oftentimes they will loan based on that value. So we call that an ARV, or an after repaired value. The only way we're going to know how to value a property once it's repaired is to know what work is going to be done to the property. So we want to get a complete budget of what's going to be done and approximately what they're going to spend, itemized. And that way, when we go out and inspect the property or we have our appraisal go out and take a look at it, we can tell if at least we're not going to, it's not like a real intensive inspection here, but we could get an idea. Does the budget make sense? So these cabinets are terrible. Do they have cabinets on their budget? This bathroom needs to be redone. Is their bathroom budgeted on their budget? So I think that's really important. One of the mistakes I see private money lenders make is they don't have their borrowers with a large enough budget, and they go over their budget and it turns into a default. So be careful with the repair estimate or the budget. And one of our requirements is we always have a 10% contingency added to that budget. Just a little bit of cushion there, because borrowers, rehab investors, real estate investors, they don't hit their budget very often. Okay, inspections and reports. So anything that you feel like might be important for, like maybe it's a sewer scope, or you're going to have, I don't know, radon inspections, that type of thing. And then appraisal, maybe important, maybe not. I like getting appraisals on our files because I think it shifts some risk and it has another opinion of value, but it's not necessary. There's a lot of hard money lenders that just do their own comps and their own appraisals, or they might have a broker, a real estate broker, do a BPO or a broker price opinion. Much faster, much cheaper. So there's other ways you can get comfortable with the value, but we typically like to see the appraisal done as well. So those are the list of what you're going to find in our files.
Hey, so Kevin, we've got a couple of questions.
All right.
Ravi is asking, for investment property loans, what are financial numbers that you will be looking at apart from property cash flow?
So we don't typically look at cash flow, and we're going to talk more about how you get paid as a private money lender, but the interest rates are typically pretty high. So you're not going to see real estate investors hold this type of loan for a rental property. What this is perfect for is to buy the property, maybe fix it up, get the tenant in, and then you want to get into your permanent loan. So for our underwriting, we're not looking at cash flow or debt service coverage ratio. What we're looking for is what's the value of the property and what's our loan going to be in relation to that value. So for us, we cap our loans at 70% of the value, 70. And I think that's important. And as the market softens, we don't see that happening soon, but it will happen at some point. We might back off of that a little bit, maybe go to 65% or something like that. But that's really how we underwrite it. Are we secure in the property where if we have to foreclose, we can and get our principal back? So I hope that answered that question. All right, Daniel, did you have another one there?
Sorry, I'm speaking on mute again.
That's
so I was going to say, Ravi, if you do have a follow-up question, feel free to unmute yourself and talk. But otherwise, another question: how different are you from lenders at the bank? For example, in terms of fees. For example, curious on what the advantages are to coming to you as a private lender versus going to the bank or others.
Okay, great. So everything I'm presenting today is basically on the side of the lender. So we're assuming that you have some money and you're trying to invest it more passively. So that's what we're talking about today. But if you're going to come to me as a borrower, I mean, that's different. And I actually kind of forgot already what you asked me. How am I different from a bank? So the bank is going to be very strict, have very strict guidelines, and kind of like a little box. Now, a bank can be more flexible than, let's say, a conventional lender like Fannie Mae or Freddie Mac, FHA, those types of things. Their box could expand a little bit with compensating factors, but they still have a pretty small box. For example, if you're going to do a rental property or an investment property at a bank, they're typically going to want 25% down, which is even a little bit more than you would find with a conventional lender. Conventional lenders, you could do 20% easily, sometimes even a little bit less with some mortgage insurance. So banks are going to tighten up a little bit on the down payment, and they're also going to look heavily at what they call global cash flow. So they're going to look at your debt service coverage ratio on the property, which how much income does the property produce, and is that enough to pay the debt, one. And then two, what's the rest of the cash flow look like? What's your income compared to your expenses, and how does that relate to the property itself? Hard money lenders don't really care about that. What we care about is, are we safe in the asset, and are we working with a borrower with at least some experience and with some liquidity to handle it if there's a problem? So those are our most important. Banks are more down payment and global cash flow. We're very much more expensive because we're so much high leverage. In fact, we could loan 100% of someone's deal if we're at 70% or less of the value. Banks would never do that. They always require significant down payments.
All right, that's all the questions we have at the moment.
All right, and then we're on to the next slide. Oh, I guess not. Title insurance. Oh, yeah. Sorry, guys, missed those two. There's two types of insurance policies that you're going to want to get on every deal you do: title insurance and hazard insurance. Hazard insurance, obviously, if there's a fire, then you can replace the property or fix it. So that the property is the collateral for your investment. So we want to protect that. And then the title commitment. There's two types of title insurance policies, and I'll just go over this real quick. But there's an owner's policy and a lender policy. The owner's policy is normally purchased by the seller of the property, and that's ensuring that your client, your borrower, the one that purchased the home, is getting clear and clean a title. The lender policy ensures that your loan, your mortgage, or your deed of trust is in the first or senior loan position and that it gets recorded appropriately. So you have a legit lien on the property. This sounds crazy, but we have filed multiple title claims because the title company screws something up, like not recording the lien, for example. And then there's other liens that get recorded in front of us, which takes a priority position, meaning they have to be paid off before we get paid off. Well, in that case, that's when we have to file an insurance claim because they didn't do their job and record the lien appropriately. So those are the two: insurance, title, hazard. And we're on to the next one. So then after you find the deal, after you underwrite the deal, now we're looking at how do you actually make the investment. It all starts with working with the title company. You call the title company, make connection with the closer at the title company, and you guys work together to make sure that your mortgage or deed of trust is correct and that it's insurable. Make sure that they have it, the signature lines, for example, the legal description. We want to make sure all of that is insurable, so they'll insure it. And you want to make sure all the loan figures are in and that the settlement sheet looks correct, or sometimes they call it a closing disclosure statement. So you'll say, okay, I'm charging these fees, I'm charging this to the borrower, I need this amount of interest paid at closing, I'm sending in this amount of money, my total loan amount is this. All of those numbers goes into the title company, and they put those with all the other numbers, purchase price, taxes, any other assessments, all of that onto one settlement sheet, and they'll send that back to you for approval. Once that's approved, you approve that, then you can wire in your money. Always wire your money to the title company, never to the borrower, and always verify the wire instructions. This is a really hot topic right now, and I've seen it in my own business, so I know it's real. Emails are getting hacked. They're sending lenders wire instructions to their own bank account, and people, lenders, private money lenders that don't understand this are sending wires to the hacker of the email instead of to the title company. So I would be very careful with that. When you get the wire instructions, pick up the phone, call the title company, not the phone number that was just in the email, the actual phone number to the title company, and just verify those instructions are accurate. So I can't say how important that is. Please do that. And then you got then you get the loan docs together and send all the loan docs in for execution. You may or may not want to actually attend closing. I don't tend to closings anymore. At the beginning, I would attend every single closing because I wanted to talk to the agents that were involved. I want to build the relationship with my borrower. I want to try to get referrals. So if you're serious about this, even if you're not doing it as a full business, you're just, 2 or 3 or 4 loans a year, you might want to go to those closings just to build those relationships. As far as executing document or getting documents to execute, I put in the slide there the Fannie Mae website, just a /single family /notes. If you go there, you can get all the documents you need for free. I will say that those are very neutral documents. And maybe if you're doing 1 or 2 of these, that might be okay. But I would encourage you to have your attorney draft a set of documents that protects you and less about the borrower. What I found is lenders don't default. Borrowers do. So you want to make sure that you're safe there. All right, you made the investment. Now we got to service it. So you got to collect the payments. I'm going to talk a little bit about this slide because there's some things that are important to mention here. When you're trying to keep your money safe in private money lending, it's about the underwriting and the servicing. And the servicing is what is often overlooked. If you get into a really solid deal because of good underwriting, you could screw that really solid deal up with poor servicing. One of the things I would say is collection of payments need to be every single month. So borrowers, without exception, will ask you, can I defer my payments until I get the house done? Or can I defer until I pay the loan off? And I would absolutely say no. Here's why. If there's a problem, the borrower doesn't call you and say, hey, I've got a problem, typically. They just don't do that. But if you're getting payments every single month from them and they miss a payment, well, now you're tipped off that there's probably a problem and you could reach out and try to find the problem. Finding the problem and fixing the problem, you could do that. If you don't, you're going to end up with the house and a loan amount that was bigger than you originally expected. So monthly payments. Monitoring the construction is big too, especially if you're doing any type of rehab financing, meaning you're financing the purchase and some or all of the repair money. Don't just give that money to the borrower. Give it to them as the work is progressing and you're doing the inspections. Like, okay, the kitchen's done, here's a little bit, for example. Or the exterior paint's done, here's a little bit. And I know this starts to become less passive when you talk about this type of servicing, but you could outsource even just this one piece, the construction monitoring, to a title company. Most title companies will do that for you. And there's other escrow services that will help you with that as well. Handling defaults and slow pays, that's probably a weekend seminar. There's lots of different ways to handle when there's a problem, but I'll say this. You don't want the house in most cases, unless you're using this strategy to acquire houses. In most cases, you want to work with your client, work with the borrower, and get them through the project. Maybe not loan to them again if they're having some trouble, but I would say work with them, whatever you can do to help them get to the end, because the foreclosures and all of that process can be very expensive. We've got one right now that we cannot keep the neighborhood out of it. It's vacant and it's really killing the value. So it's going to be one of very few that ever happened, but this is going to be one of those that we end up taking a loss on. So I wish we didn't foreclose on that one, but it is what it is now. So payoff statements and releases, whenever your borrower is ready to sell the house or refinance it into their more permanent loan, they want to pay off you. You're going to have to create that payoff statement, which details what's the principal, what's the interest, all the other fees, and then you send that off to the title company. And again, that gets put on the settlement sheet, and that's how you get paid off. And once you're paid off, you can release the lien. Some title companies will ask you to send in the release before they send you the money. If it's a big title company, Chicago Title, something like that, maybe that's okay. But I would make it a practice to never release a lien until the money is in your bank. So definitely my advice would be push back to the title company if they're trying to get you to release a lien without being paid, which will happen. And then tax forms, this is really simple. Your CPA or accountant can do this, but it's appropriate to send your 1098s out to your borrowers for their interest expense. And then that gets reported to the government as well. So that's a pretty simple one. All right, let's talk about how to how to profit. This is the fun part, right? So I mentioned to you back in 2006 and 7 and 8, we were charging 4 points in origination and 15% interest. Well, a lot of institutional money has come into this space. So it's become, it's put a lot of pressure on pricing. Let's just put it that way. So you're not seeing the 15% interest rates anymore. And I didn't even put points on here. I probably should have. A point, for those of you that don't know, is a fee, a lender fee, and 1 point equals 1% in a fee. So if you're going to loan somebody $200,000 and you're going to charge them 1 point, that's a $2,000 fee that goes into your pocket just for making the loan to them. So you could charge points and interest. You can charge points or interest or a combination. Typically, we charge about 2 points. It varies a little bit depending on location and our relationship with the client. But let's just say it's 2 points and 12% interest is our fees. Very common across the country to charge between 8 and 12% for these hard money or private money notes. So that's the kind of returns you should be expecting. And you could partner with people too. It doesn't have to be a set interest rate, even though that's the most common way to do it. You could say, okay, I'll fund your deal for you, but you got to give me half the profit, or you got to give me 30%, or whatever the numbers are. Or maybe you could say, I want a 5% return plus 20% of the profit. However you want to structure that, we've seen it all. If you structure some kind of partnership, definitely do either a joint venture, which can be done multiple different ways, a shared LLC, a separate partnership or joint venture agreement. Those could be a little risky because they could still sell the house without you knowing it. For that reason, I would say, even though that's good to get a JV, it's better to record something against the property. And we've called it, what our attorneys have called it, is a shared appreciation deed of trust or a shared appreciation mortgage. So really all that is you get them to sign a note, and then the note is secured by a lien, a mortgage, or a deed of trust. But in the mortgage or deed of trust, it just says, hey, this is securing 35% of the appreciation or the profit in the deal. And that's how you secure your partnership arrangement with your borrower. And a lot of people don't know about that one. So even if you call your attorney, it might throw them off. So definitely a good lending or real estate attorney should be able to help you, but just any attorney may have never even heard of a document like this. Okay, so there's 2 ways to invest in private money. The individual route, which is exactly what we've been talking about this whole time, or you can invest in some type of mortgage fund. Many, many hard money lenders, in fact, it's almost universal across the country, have mortgage funds or pools. What that is pooling money together and going out and making the loans that we've been talking about. So advantages of the individual loans is you may get the property back. I kind of think that's not an advantage, but sometimes it is, because you're lending at such a low loan to value. If you get the property back, there should be some equity there for you to have additional profits. So some people, especially people like you guys that are on a call like this, understand real estate better than most investors, and maybe you want the property back. So that is a potential with individual loans. And then it's absolute transparency. You cannot get more transparent in an investment than you are with private money lending. And the reason for that is your note is secured by a property. So you have a loan with your name on it. You have a deed of trust or a mortgage that's recorded with the county. You could get on the county website. You could see your lien. You have the title insurance, knowing that it's in a senior position. Now I could drive out to the property and touch the property. It's just very transparent. When you get into the pool side, it's not as transparent. It's more like a mutual fund. You invest in a mutual fund, and you really most of the time don't even know what you're invested in, right? You're invested in the manager, not what the decisions they're making on the stocks they're buying. So it's the same concept here. If you pull that up, Daniel, we can see the advantages of that. So in the individual notes, it's important. This is kind of important. You might be making your 10 or 11 or 12 or 8 or whatever % on that note, but that's only as long as the note's out. So let's say you have $200,000, and you loan out $200,000, but that loan pays off. No, now you got to go out and find the next deal. So you might have a month or 2 months or whatever of no interest at all. So that brings your returns down over a year. In a fund or a pool, you're invested 365 days a year, so it's very consistent. It's diversified over several properties. And I hate to scare people, but this is reality. You could invest in a property that turns out to be a meth house, or turns out to have mold, or turns out that the foundation is bad and no one saw it because it was covered with drywall. Those types of things can happen. And if you're in a fund with millions of dollars invested in lots of loans, a problem like that, although it still is going to impact you, it's going to impact you very little. If all your money's in an individual loan and you get one of those, that's going to be a big, big hit. So the diversity of the pool is a huge advantage, in my opinion. It's truly passive and liquid. You're not going to have to worry about tenants and toilets and vacancies, and you're not going to worry about the construction draws and inspecting the property and all of that. You never have to worry about getting a house, as we mentioned. You don't deal with the foreclosures, the mispayments, any of that. I mean, one thing I didn't put on here, but is very true, is if in my example of the $200,000, if you have the $200,000 to lend and you want to make an individual loan, that's fantastic. But the chances of you finding a loan for exactly $200,000 is small, I think, unless you decide you want to go over your loan to value ratio. But typically what you would find is, well, I got a loan for $196,000 or $192,000 or 180 something thousand, and there's always just a little excess cash that's going to be earning you nothing, while the loaned out money is earning you a high return. So a blended rate comes down a little bit on the individual notes as well.
All right, Kevin, we've got a couple of questions here, and Jesus is asking two related questions here. Is private money considered in the typical DTI ratio that a bank would look at? So are you doing the same sort of ratios there? And then a similar question is, do you lend at 70% LTV, loan to value, of the after repaired value or of the initial value of the property?
Yeah, those are both fantastic questions. So I'm gonna go to the DTI first, debt to income ratio. No, and that's the same answer as I gave earlier about the banks and the bank requirements and how they look at a global cash flow and the debt service coverage ratio. That's more on the commercial side. When you say DT, debt to income ratio, you're talking more on the residential side. So something like a Fannie Mae or Freddie Mac would be looking at. And all that's asking is, do you have enough income to pay the mortgage payments? And we don't look at that. In fact, the DTI never makes sense. We have 100, 200% DTIs. And the reason for that is we have a vacant property that's being rehabbed at a high interest rate loan, right? So that math just doesn't work. We're not getting paid back on the DTI. We're getting paid back when the house sells or is refinanced. So we're much more concerned with liquidity, that the borrower can make the payments with money in the bank, and that the property is going to pay us back. So that's what we're looking at. The other question was, what was that other one, Daniel?
Do you lend on the question? After repaired value?
Yeah, thank you.
Or the initial value?
So when in the lending business, we have the two ratios, the loan to cost, LTC, and the loan to value. So banks and conventional lenders always look at the loan to cost first, which is going to force a down payment, right? Because I'm going to loan 80% of your costs. Now, when we're talking about values in lending, there's as is and there's ARV. As is typically purchase price or opinion of value, typically an appraisal. But the purchase price or appraisal, whichever of those two is less. And most times that's going to be the purchase price when we're talking about savvy real estate investors. So that's basically the same thing as a loan to cost ratio. So to answer the question, I know this is a long way to answer the question, but we look at loan to value on the after repaired value. What's it going to be worth once it's all fixed up? But we are going to hold back the repair money to be sure that we get the repairs done to hit that after repaired value. And we have a whole process, and I would recommend, if you're doing this, to have some type of process to issue those in draws as construction is complete.
All right, a few more questions. What security do you get in a pool deal? So I'm assuming this is talking about in an individual deal, the mortgage note is a lien against the property. What security do you get in a pool deal?
Yeah, it depends on how the pool is structured. And I've got a couple, and I know other hard money lenders that are going to be similar to this. So if you're in an equity pool, you're buying into the company itself. So most pools are set up as an LLC. So when you invest in that fund or that pool, you'll be buying units in the LLC, very similar to shares of stock in a company. So your security is a little piece of all of the notes. Now, we've moved over to more of a debt offering personally, and I know other lenders have done this as well. And the reason we've done that is we could promise a return. The downside to that is now you're lending money to the company, and then that company is using the money to lend to real estate investors. So it creates a little bit of a gap there in the security, and you're a creditor to the company, so you're paid out first, but there's no direct collateral, if that makes sense. And that gets a little bit more complicated, but how do I describe that and try to make it not complicated? You're creating a little bit of space because you're loaning an LLC money that is using the money to create the liens. The LLC as the collateral, not you personally. But creditors are the first to get paid out in the case of a liquidation or a problem with the entity.
Okay, Ashish wants to know what percentage of your loans don't perform each year as expected?
Yeah, very, very small. So we've been doing this for almost 13 years. It's never been over a 3% default rate. Right now we're about 1.9, probably because the market's so good. But yeah, I would say 1.5 to 3% of our loans go into default, meaning we'll get the property back. And it's a little bit over half of those that we're able to negotiate a deed in lieu of foreclosure instead of actually foreclosing. So I mentioned earlier that the problem property we have, it's actually here in Minnesota, which is interesting that I'm here now. But so we loan in Minnesota and Colorado, like I mentioned. And in Minnesota, you have a 5 to 6 month foreclosure timeline with a 6-month owner redemption, which means they have 6 months to redeem you and not lose the property to foreclosure. So now we're talking about a year process if we have to foreclose. So we get pretty aggressive when we know we have to repossess the property to get a deed in lieu of foreclosure. So we might even give the borrower a little bit of cash to just deed it back to us so we don't have to go through that year process.
All right, and Mario is asking, how do returns compare between individually lending on a property and pooling? And then how does this also compare to other group investments like Fundrise?
Yeah, so Fundrise is the way I understand Fundrise. It's a crowdfunding source. So you'll be investing in other people's deals, small pieces of it. So you'd have to underwrite that individual deal to know that that's a good investment for you. If you're talking about hard money lending and investing in a hard money lending company, and you want to invest in their fund, every hard money lending company's fund is structured a little bit differently. So it might make sense to call around and maybe get a few prospectuses. But I think you're going to be in the 8 to 10% range on those, on the funds. Private money lending individually, now if you're out there doing it on your own, you could charge points, like 2-3 points, which is those fees we talked about, plus that 8 to 10% interest. So it would pay far better to be on the individual side if you're willing to put in the work, to find the deal, underwrite it, and service it. Working with a broker that does the individual for you, you're probably 8 to 10% range. So I guess it's going to be similar to a pool if you're working with a broker that finds it and services it for you.
Okay, Fani Chandra has a couple of good questions here. Quick ones. Who's your typical clientele? What do you do to screen them? And for investors, are there times that they can enter and exit your funds? And how do you describe those?
Yeah, that's one of the things that I love about the way we structured our fund is it is liquid. And I think we might be, as far as I know, I'm sure there's more, but I haven't seen them. Mortgage funds that allow you to come in and go. And we do that because we have so much volume coming in and going that it enables us to be able to return funds. Now, it's not instant, but a little bit of notice we get the money returned to you. How do we qualify? Well, we talked about that in the slide earlier. We look at the financials, we get a valuation on the property, we review the budget, We pull the credit report, and then we underwrite the deal. What we're primarily looking for is a quality real estate deal for our client. They're going to be profitable. Even if we're safe and they're not going to be profitable, we won't do the deal. And that's why we have so much repeat business. And it's been, I can't even tell you how many times we've turned down a deal and they went and funded it with another lender and then called us back and said, yeah, I should have listened to you. But that's sucks for them for that specific deal, but it's great because now we have a relationship and we're going to make money together. So that's really what we're looking for when we're underwriting the deal, the quality deal, and that they have some liquidity. I think I got all of her questions there.
Yeah, I think you did too. He's asking a follow-up question actually to the previous topic that you were talking about. But if you're investing in a pool, do you end up I think he's just looking for some clarification here. Do you end up actually owning the note or a physical property? It wasn't clear.
Yeah, in a pool, you would never own a property. The manager would take that on. And so for us, at least right now, we liquidate everything that we get back. We're in the lending business in this fund. We're not in the own real estate business in this fund. Now, do we have the option? Yes, and we want that option because if we see a softening in the market and we can't sell the properties to get our principal back, then we might want to hold on to the properties as rentals until the market can come back and we could liquidate at that time. So we want that flexibility, but even the way it's structured right now, even the fund wouldn't own the property. So yeah, you wouldn't have to worry about that. And his other question was about what am I getting? So that you'll be getting and it's hard to answer that question because everybody's fund is so different, but I'll just say for ours, you would be getting a promissory note with a promise to return your investment with a 8% return.
All right, that's all the questions we have currently.
All right, I know we're running short on time here.
Yeah, let's make sure we put your contact information up there. But how close are we to the end of your presentation? Should we just continue going through it?
I think let's just cruise for another 4 or 5 minutes, and then if we're not, we can just get to the end and answer any last questions here. All right, but one advantage of the fund we'll go through real quick is compound interest. So for us and many of the other hard money lenders, they allow you to reinvest your profits. So you don't need to take a payment every month. You could just keep reinvesting it. And if you know anything about compounding, Ben Franklin said it's the eighth wonder of the world. And so this is an example of if you have $150,000 I'm using an IRA, for example, your IRA is going to be maxed out at a $6,000 contribution a year. So say you start with 150 and you add 6,000 a year, then let's just say you get an 8% return because I'm confident that you can get that in this type of investment or in this business. So you could see after 10 years, you have almost 500,000, $417,700 in the account, which is going to produce, if you hit over one more time, you'll see it produces an income of, what is it? You got to click it over one more, Daniel. There we go. After 10 years, it's going to produce an income of $2,700, almost $2,800. And that's going to be without tapping into your principal investment. So that'll just be income, $2,700 every month forever. But here's where the power of compound really comes. If you go another 10 years, so the next slide is going to show years 11 through 20, and just click that one more time, you'll see you'll get almost $1 million just by that little $6,000 investment, as long as you give it time. And then you'll have income of $6,600 without touching principal, and that'll go forever. Now, if you do tap in, let's say you retire and you don't need the huge retirement account, but you want a little bit more income, you could tap into that principal also. So you could see that this can create a nice little comfortable, especially if it's only one strategy and you have multiple investments. One little strategy here can really beef up your retirement years. So I think I want to talk about how to stay safe if we have the time. Oh, finding money to invest. This is a slide. I don't know if we're gonna have time to go through this, but these are different ways you can come up with the money. If you have self-directed IRAs or 401ks, you could borrow from 401ks. Oftentimes, you could use other people's money, which is exactly how I got started in this business. And then you could borrow. Borrowing has some risk. Obviously, it's a double-edged sword. You can create some awesome things with leverage, and it could take you down. So I'd say be very careful with this. But the next slide just goes through an example if you're using a HELOC. And I'm using a HELOC of prime plus 1, so it's a 4.25% interest rate. I think it's very easy to get that right now. And let's just say you have a $200,000 deal. The simple math tells you you'll make $625 a month on that investment. And that was with borrowed money. So that's zero money out of your pocket. You just created $600 a month. So that's one way to increase some income. And then here's the pitfalls. Let's do this. If you go to that very last slide, this is what you and I talked about earlier, Daniel. We wanted to give these gifts away. One of those is the lender pitfalls report, which I go into a heck of a lot more detail on how to stay safe with this investment than I would have had time for in this presentation anyway. So if you wanted to go to pinefinancialgroup.com and go to the resources, it's up on the top menu. You could download these 2 reports. There's other reports and stuff, but these are the 2 that are focused on the private money lending side. And I think it talks a lot about what we do, what we talked about today, but in more detail. So I think this would be really beneficial for anybody interested in the private money lending investment. So I know we got, what, 5 minutes left, so we can take some questions. We can take some questions now, if you'd like.
Sure. Ashish is asking, what's the typical return offered in a pool? Do investors' returns increase if you have more turns where the property sells and you make your 2% origination fee more often?
So in a pool, there's not going to be any origination fee. I don't think you would see that in any hard money lender's pool. So you're going to get probably a pretty set return. Sometimes it'll be a very set return between, say, 8 and 10%. Sometimes you'll have a preferred return plus an upside. So you might see a 6, 7, 8% preferred return with, if the fund produces X amount, then we're going to kick back a certain amount to an investor. So a lot of hard money lenders will do that. But I would say going in, just to give you an idea, if you're between 8 and 10%, that's right in the range of what you should expect in investing in a pool. Now, if you want those fees, the points or what you just mentioned, you really should be on the individual side and either originating your own loans or using some type of mortgage broker or private money loan broker to find those deals for you.
All right. We don't have any more questions at this time. So if you would like to ask, one just came in. Is there a limit? 2 just came in. Is there a limit for the money you can lend? And is there a typical minimum investment amount to join the pool? But you know what? Before you answer those, can we just have everybody come off mute and thank Kevin for coming in?
Thank you, Kevin.
Thanks, Kevin.
Thank you.
Thanks, Kevin. That was great.
Thank you, Kevin.
Thanks, Kevin.
That's great.
Thank you.
All right.
That was nice.
Yeah. Is there a limit for the money that you can lend, and what are the typical minimum investments to join a pool?
So the minimum investment for us is $25,000. So if you go to some other hard money lenders, they're probably going to be a bit higher than that. We tried to keep the entry point pretty low. So $25,000 minimum. Now, if we're going to lend money out to a borrower, do we have maximum loans? We really try to stay under 5 million, which probably sounds like a lot of money, but some of our deals are big commercial projects. So on that type of things, we'll go up to 5 million. But I got to tell you, those are pretty rare. Most of our loans are this residential fix and flips. Denver's a little bit more expensive. We might be at a 400, 450. It's somewhere in there, average loan amount.
All right. Well, thank you so much, Kevin, for coming in and sharing with our group here at Intel. And I hope that everybody here has a great weekend. We'll see you all next week.
Yep. Thank you so much, guys.